What if one of the safest flex investments of the last decade, Rolex watches, didn't just cool off, but quietly exposed how fragile hype really is? In this video, we're unpacking why Rolex prices crashed. Not because the brand suddenly got worse, or because people stopped loving mechanical watches, but because a perfect storm of cheap money, social media hype, dealer games, and manufactured scarcity finally ran out of oxygen. By the end, you'll understand exactly how the bubble formed, why it popped, who got burned, and how to think about value, collecting, and status in a saner market. To see the crash, you have to see the run-up. Go back to the late 2010s and early 2020s. Interest rates were close to zero, stimulus and booming markets filled a lot of pockets, and the internet made every status symbol instantly comparable. You didn't have to know anything about horology to recognize a stainless steel Submariner, a Daytona, or a Pepsi GMT. Influencers wore them, finance bros wore them, rappers wore them, startup founders wore them. At the same time, travel and experiences were limited by lockdowns. That treat-yourself impulse had fewer outlets. Luxury watches, compact, shippable, and highly visible, became a perfect target. Rolex already had something most brands dream of: demand that outweighed supply for key models, plus a reputation for rugged, reliable movements. But what used to be a mild shortage turned into theater. Authorized dealers kept long lists and short answers. Stories spread. You can't just walk in and buy a steel sports Rolex. You need purchase history. You need to buy jewelry first. You need to be chosen. That narrative did two things at once. It made owners feel special, and it pushed hungry buyers to the secondary market. There, the real bubble started. On the gray market, scarcity became spreadsheet-able. A Submariner with a retail price in the single digits of thousands suddenly sold for twice that from dealers and platform. Daytonas went even crazier. Buying at retail felt like winning a lottery that paid out instantly. Charts flew around forums and Instagram. Lines only went up. YouTube channels titled videos with phrases like "Rolex as an asset class," "Why your sub is better than Bitcoin," "My watch collection made more than my stocks." Every flex became a financial flex too. Not just "look what I have," but "look how much it's worth now." Scarcity, though, wasn't purely organic. Rolex doesn't disclose model-level production, but we know a few things. First, Rolex didn't suddenly cut overall output in half. They kept investing in capacity and vertical integration. Second, certain references, particularly colorful or niche dials, were produced in lower volumes, but not in mythical single digits. Third, authorized dealers had an incentive to dramatize waitlists. Long lists justified careful allocation, subtly nudged customers toward less hyped pieces, and gave ADS leverage to push bundles, buying jewelry or less in-demand watches to get nearer to the grail. That environment turned what should have been a durable good into a speculative ticket. Then a global backdrop poured gasoline on everything. Money was cheap. Central banks pinned rates low to fight crises. People at home with time on their hands discovered watch content, forums, auctions, and resale platforms. Flipping culture migrated from sneakers and streetwear to stainless steel. It was the same playbook. Limited supply, visible logos, a story you could repeat at dinner. I paid X, it's worth 3X now. Underneath all of that was one assumption. Demand would always outpace supply, and Rolex would never let prices soften. But macro never sits still. Inflation spiked. Central banks reversed course and hiked rates aggressively. Suddenly, the cost of holding inventory wasn't negligible. It hurt. Dealers who had loaded up on multiples of the hottest references now had to pay to carry that steel wall. At the same time, pent-up travel demand exploded. People who would have put 10 or 20,000 into a watch now spent it on flights, hotels, and experiences. The cultural pivot was subtle but real. After years indoors, the flex shifted from "what's on your wrist" to "where are you actually going?" On the supply side, Rolex kept doing what Rolex does, building long-term capacity. New facilities came online, training pipelines bulked up, and output steadily increased. While they didn't flood the market, they did what any rational company with healthy demand does: supply more, but without compromising QC. Even a small percentage increase in production of hot models cascades into the secondary market when that market is no longer growing at breakneck speed. The fragile balance between waiting list mystique and real deliverable product began to tilt. Then came the move that rattled the gray ecosystem: Rolex certified pre-owned. In partnership with select retailers, Rolex effectively said, "We will bless certain used pieces service, and authenticate them, and put them in our own showcases with our own seal and warrant. You can debate whether CPO pricing was rich or reasonable, but one thing was clear: the brand officially stepped into the resale stream. That sent a message to independent dealers and flippers. You are no longer the only trusted channel for secondhand Rolex. Some welcomed the legitimacy, others saw margin compression ahead. Either way, another crack appeared in the speculative story. Meanwhile, on forums and in watch shops, you started hearing different tones. These prices are nuts. I love this watch, but not at that number. I'll wait and see. Bubbles don't pop when everyone rushes to sell at the same instant. They pop when the marginal buyer refuses to pay the last crazy price. That's when inventory backs up. Gray dealers quietly started offering more for trade-ins and less for outright buyouts. Asking prices on platforms stayed high for a while, but actual transaction prices, the bids where money actually changed hands, drifted down. If you watch closely, you could see the air leak out before the headlines caught up. Another factor: content fatigue. During the boom, a lot of watch coverage focused on price action. This reference went from X to Y in 18 months. This dial is trading at a 40% premium over that dial. That content is addictive when the arrow always points up, but when it flattens, or worse, turns down, people tune out. You can only watch so many "my watch portfolio is crashing" videos before deciding you've had enough drama. As eyeballs drift to other topics, travel, cars, business building, the watch market loses constant hype oxygen. Without that reinforcement, the belief that these will always be liquid and mooning weakens further. So we arrive at the crash. In many models, it wasn't a total implosion, it was a repricing. Some references that traded at 2 to 3 times retail drifted down to 1.3 to 1.7 times. More speculative colorways and hype dials saw sharper corrections. Certain configurations even slipped toward, or in rare cases below, retail. People who bought late in the sunshine, especially with leverage, found themselves bag-holding watches whose paper profit disappeared. It felt like a crash because it punctured the story that Rolex steel was basically better than cash. But here's the critical thing: Rolex, the company, didn't suddenly collapse. Authorized dealers still had demand. Retail prices ticked up in measured steps, not down. What really crashed was the speculative premium, the froth above an already expensive but defensible baseline. To understand this clearly, split the price into layers. There's intrinsic product value, the cost of materials, movements, engineering, QC, labor, plus a rational margin for a well-run brand with high standard. There's brand and ecosystem value, the service network, the heritage, the recognition, the resale infrastructure, the trust. And then there's speculative hype value, the extra chunk people pay because they believe someone else will pay even more later. In the boom, that last layer ballooned. In the crash, that layer deflated. The first two remained more or less intact. Interest rates quietly attacked all 3 layers at once. Higher rates mean saving is rewarded, borrowing is painful, and carrying high-value inventory turns into a drag. For dealers, that means less appetite to sit on stacks of identical watches. They need them to move. For speculators, it means the cost of tying up capital in a non-yielding asset is higher. For everyday buyers, mortgages, car loans, and business credit lines eat more of the budget. A watch at double retail suddenly looks less like a smart store of value and more like a very expensive toy. Another pressure point was rising choice. During the frenzy, many people wanted a Rolex first and a specific watch second. Now with the heat dialed back, buyers look around. Omega, Grand Seiko, Cartier, Tudor, independents, and micro brands all stepped up their game. You could get stunning finishing, interesting complications, and real stories at prices far below what a hype Rolex commanded on the gray market. As alternatives became more compelling and available, the willingness to pay strangled premiums for a crown logo waned. Resale infrastructure also matured. Platforms got better at showing live data, recent sale prices, trends, and spreads. Buyers could see that the last few transactions weren't matching the ambitious asks. In any market, once transparency increases, unjustified premiums struggle. Dealers who clung to peak pricing simply didn't transact. Stocks sat. The more rational dealers started setting prices where watches actually sold, dragging the entire curve down. This doesn't mean everyone lost. Enthusiasts who waited or who bought earlier for love, not flips, now get something closer to sanity. They can buy a watch to wear without feeling like they're late to a Ponzi. People entering the hobby can focus on design, movement, and personal fit instead of chasing what's hot. Even Rolex benefits in the long run from a more stable market. Fewer robberies driven by extreme street values, Fewer horror stories about needing to buy $30,000 of jewelry to access a steel sports piece. Fewer headlines comparing Daytona charts to altcoin. What remains is a more mature way to think about value. If you're considering a Rolex now, you can ask 3 cleaner questions. First, do I actually like this watch? The dial, the proportion, the thickness, the weight on my wrist. Second, can I comfortably afford the retail or near retail price without betting on appreciation? If the watch never goes up and even goes down some, is the joy of wearing it still worth it? Third, am I buying from a channel that respects me? That means transparent condition grading, fair disclosures, and realistic pricing, not lottery theatrics. A word on the Rolex CPO program in this new reality. Certified pre-owned pieces from brand-aligned dealers often carry a premium over generic secondary sellers. You're paying for a factory-backed service and warranty, deep authentication, and an experience that feels close to buying new. In a frothy market, that premium looked tiny next to wild gray markups. In a normalized market, you feel it more. Some buyers will still find it worth it, especially first-timers nervous about fakes. Others will prefer trusted independent dealers or peer-to-peer platforms to save money. The crash taught a simple lesson. Brand promises matter, but so does the math of fees, taxes, spreads, and premiums. Let's talk about those who got hurt most. It wasn't the lifelong collector who bought a sub 10 years ago and wore it hard. It wasn't the person who saved and bought a Datejust they planned to keep for decades. It was the highly leveraged speculator who bought at or near the top expecting a quick flip. The buyer who overextended because they were told you can always get your money back or more. The new dealer who built an inventory wall with borrowed money and no diversified income. For them, the crash wasn't theoretical. It was pawn shop offers, margin calls, or quiet liquidations at losses. Every bubble has victims. Watches are no exception. There's also a reputational lesson. For a few years, watch content leaned heavily into investment talk, graphs, dollar signs, portfolio updates. That angle brought in audiences, but also distorted the culture. A crash forces a reset. The best creators and communities will pivot back toward horology, movements, finishing, history, design language. They'll highlight overlooked references, independence, and stories, not just this color dial is a 35% premium. That's healthier. It preserves love for the object beyond the ticker symbol. So, where does Rolex go from here? Most likely they keep doing what made them dominant. Gradual, careful evolution, rational capacity increases, a tight, coherent catalog, and a service ecosystem that keeps 50-year-old watches on wrists. They don't need to chase the secondary market. They just need to ensure that their primary buyers feel the product and experience justify the official price. They will keep a close eye on counterfeiting, continue refining CPO, and build boutiques and network capabilities for the long term. Bubbles come and go. Rolex plays for decades. As a buyer, your advantage now is perspective. You've seen what happens when speculation runs wild. You've seen a supposedly bulletproof market flinch. That's a gift. It gives you permission to buy differently. Instead of asking, what will this be worth in 3 years? You can ask, what will this mean to me in 10? Instead of needing the hyped configuration everyone else posts, you can find the one that suits your wrist and your wardrobe. Instead of chasing the crowd, you can develop taste. You might also think more broadly about what status and joy mean. A watch can absolutely be part of that, but so can travel, learning, building a business, or supporting people you care about. The crash reminded people that a steel case doesn't automatically confer wisdom, wealth, or happiness. The ones who look best through the cycle were those whose identity didn't depend on lookup values on a resale app. Zooming out, Rolex's price crash is a microcosm of a bigger pattern. We saw similar arcs in sneakers, trading cards, crypto, meme stocks, even certain art niches. Cheap money and internet amplification create fast upswings. Human nature extrapolates lines forever. Then conditions change, momentum stalls, and reality reasserts itself. The people who come out ahead are those who, 1, understand underlying value, 2, avoid leverage, and 3, never confuse temporary market heat with permanent truth. The permanent truths about Rolex are fairly simple. They make robust, well-engineered watches with strong QC. They maintain a service network that keeps pieces running for decades. They've built a brand that means something almost everywhere. Their watches will continue to be desirable, just not always at fantasy prices. If you align your expectations with those truths, not with hype graphs, you'll be fine. And if you lived through the bubble, you now carry a small, hard-won immunity. Next time you see a chart of anything luxury going to the moon, you'll remember submariners trading hands like crypto coins, then sagging. You'll remember the dealers suddenly eager to negotiate. You'll remember that buying what you genuinely value at a price you're at peace with beats trying to use consumer goods as a get-rich-quick scheme. In that sense, the crash was a correction not just of prices, but of perspective. Rolex didn't become worthless. It became watchworth again. That might feel like a loss if you were in it for the trade, but it's a win if you're in it for the watches. If this deep dive helped you see past the hype cycle, do your future self a favor. Hit like so this breakdown resurfaces next time you're tempted by a can't-lose luxury play. Subscribe for more clear-eyed looks at how status markets really work, and share this with a friend who still quotes 2021 Rolex prices. Smarter buyers make better markets and much better risks.